Hello and welcome to the Risk Reduction webinar. My name is Doug Johnson. I am the Senior Investment Strategist here at HCM. And just wanted to take some time to provide some details on a recent portfolio change that we've made in most models to reduce risk in light of the recent market volatility that we've seen. So we're going to try to give kind of a Cliff Notes version of what we did at the beginning of this webinar. And then for those who have the time and inclination to listen to the more specific details, we will provide those as well. So just to get started here, so what exactly did we do? We made the decision to cut our equity exposure by approximately 6% across most of the models that we manage and move that money into short-term treasuries. Now, the short-term treasury exposure will be gained through an ETF, through Schwab. The ticker on that is SCHO. The exposure was taken from a combination of U.S. and international positions, so we didn't focus on either side. This was kind of a broad equity cut. So when you see the trades coming through, you may see multiple positions from both U.S. and international. Again, there was no specific targeting of anything. This was more of a broad cut, so to speak. And then we're sending this out on December 21st, but we wanted clients to be aware that most of the trading was done at the beginning of the week of December 17th. So this week has certainly been very, very volatile to the downside, but we were able to get a majority of the trades in earlier this week and avoid some of the bigger days that we've seen, particularly Thursday. So why did we do this? We have an internal research process commonly referred to as our bear market playbook, and that has indicated that risks have increased to a critical level. Now, this isn't just simply looking at the price of the S&P 500 and saying, okay, it's gone down 15%, we need to do something. There's a lot more steps and indicators involved than simply paying attention to what the price is doing. So that process involves both fundamental and technical factors. It's also completely objective. So we want to make sure that we've removed emotion from this process. Emotional and behavioral biases are one of the biggest hurdles that clients, advisors, managers run into in markets like this, where they react a lot on feeling, and that can get you in trouble. So we wanted to make sure that this process was defined, it was repeatable, and it's very objective. So we feel like we've accomplished that through our through our research. We believe that protecting capital in down markets is important, if not more important than being 100% invested all of the time. So if you are not losing as much on the way down, you've got more capital to invest when we do reach a bottom eventually, and that will generate higher returns and higher portfolio values when the market begins to trend higher. So the ultimate goal is to be equal or overweight equities when the long-term market trend is moving higher, and underweight when that trend is moving lower. So if you consider 2018, it's been a very volatile year. We've had two 10% corrections in the same year, which has only happened one other time in history. So I think some have looked at that and said, okay, well, there's probably been better times to do this throughout the year. And I think in hindsight, that's pretty obvious. But we're not necessarily looking at these things in the lens of a year, a month, a quarter. These are intermediate, longer-term trends that we're paying attention to, and we feel that that's going to be the best way to judge when times are appropriate to reduce risk, like we're doing right now. So what comes next? So we're going to continue to monitor, our internals, price action in the market, fundamentals, and really, the next step is going to be one of three things. It's either going to be we're going to reduce risk even further than we already are. We're either going to maintain the current positioning, or we're going to go ahead and re-risk portfolios either back to neutral or overweight equity. So we're not trying to predict the future, so to speak. we know what we will do if certain things do take place, but we want to go ahead and kind of let the market dictate that. And as we go along, we'll use our bear market playbook to kind of guide us. So, our goal in all this is we want to be transparent about the process, and we want to have frequent communications with clients to address our thinking and strategy. We feel like an informed client is a good client, and we don't want to leave clients in the dark in times like this and kind of hide and just say, hey, just buy and hold. Don't worry about it. Stay the course, because we don't necessarily believe that's the best way to manage money. So to go ahead and address one last issue here, we've had a lot of clients kind of say, why now? We've even had some of the advisors say, why now? As I mentioned earlier, our process works off intermediate and longer term trends. So they're not necessarily going to catch the top. They're not going to necessarily catch the bottom, but we feel like they will catch enough of both the down and the upside to make a meaningful difference for clients and provide a significant value add over a full market cycle. So just because the market's dropped 15% or so from the high level in September, that's not immediately an indicator to go ahead and do something. I mean, we had the same situation take place in February of this year, and a lot of the things that we pay attention to, we're not even close to triggering any kind of sell signal. So it's not an absolute drop that's going to dictate things. It's a multitude of factors that are going to dictate things. And when we reach those critical levels across those factors, we feel like it's the best time to go ahead and take initial action. So to address more of the details of exactly what's going on here, I mentioned briefly why now a minute ago. If you look at this 5-year chart of the S&P 500, I think what you can see is the longer term trend has been positive. So HCM hasn't been underweight equity since 2013. So it's been quite a while since we've been in this position. What you'll see is that since that time, the market has gone up pretty significantly. So we've been equal or overweight equities that entire time. So we've been able to capture a good majority of that run. Now, the peak happened September, and we've seen a little bit of a pullback. So even though we're deciding right now to go ahead and reduce equities, you can see that, the old adage, buy low, sell high, we're still certainly selling high over the lens of a 5-year window, and we've been able to capture a lot of returns. We may not be selling high in the lens of the past 2 or 3 months, but evaluating very short-term moves like that is kind of a fool's game, we feel. So we're going to focus on our longer-term trends, and we feel like this is still a good time to begin this process, even though we've had a little bit of a sell-off already. So we'll start with kind of the fundamental issues that have led to this decision. So valuations, first and foremost, valuations are not a good indicator of anything over the short term. What they are very accurate in is predicting what the future returns will be over a longer period of time. So for instance, the higher the PE ratio is, and the PE ratio is just a common valuation metric that describes really how much you're going to pay for $1 of earnings from a company. The PE ratio spiked at the beginning of this year. It's dropped down to its 5-year average on a trailing basis. But in terms of being expensive, it's probably still a little bit pricey. You can see that it's still above its 10-year average when we look at that. If you look at 2008, look at 2011, you had PEs that were significantly lower, and those ended up being really, really good times to go ahead and put money to work. So valuations by themselves aren't enough to act, but we need to be mindful of everything else that's happening right now and knowing that we're starting from a point of high valuations and to be aware of that. Another thing that we've been paying attention to is earnings. So earnings on an absolute basis have been very good. You're looking at 23% earnings growth over the last quarter, which is the highest since 2010. And that was the time you were coming out of the Great Recession. You had very low comps. There wasn't a whole lot of headwind. Now you are operating from an environment where there's been really good growth. We've been in a bull market and an extended economic cycle for almost 9 years now. That's tough to do. So the idea that earnings may be peaking has certainly come to the forefront. And CEOs and CFOs of companies who have done conference calls recently have shown some trepidation about growth going forward. They've lowered some forecasts. I think that spooked some people in the market. I mean, this may have been the initial, straw, so to speak, that began this sell-off. So we're paying attention to earnings pretty closely. They still can be good on an absolute basis, but on a relative basis, in a market that's kind of been priced for perfection, if they're not perfect, that can cause people to readjust their forecasts and then essentially readjust valuations and readjust asset prices, which we may be seeing right now. Next, we're going to touch on the Federal Reserve and monetary policy. So on Wednesday, the Fed decided to raise rates another 25 basis points, which was a decision that some people didn't agree with. Some people thought that they would pause based on some of the economic numbers that had come out, the market activity. But the Fed kind of stuck to their guns and said, hey, we feel like we need to continue to raise, and we're not going to worry about what the market's saying, so to speak. So I think, from a philosophical standpoint, you could argue, for hours about what the Fed has done over the past 8 years, whether it's good or bad. And I don't necessarily want to get into that today, but I think what we can agree on is that the Fed's quantitative easing or monetary easing programs have been very beneficial to markets. If you look at the chart on the screen, that blue line represents the total asset level of the Fed's balance sheet. You can see from the first QE program back in 2009, it's grown pretty substantially, almost 100% at its peak. With that, you have the orange line, which is the S&P 500, following that pretty closely up until 2015. So the correlation has been very, very high. And some have even asked the question if the only reason the market has generated so much return is simply because the Fed has been providing such a tailwind. Whether or not that's the case, I think is irrelevant at this point because the market goes up for whatever reason it wants to. But what you saw is when the Fed stopped the quantitative easing program and that blue line started to move sideways, the market paused a little bit. You had two kind of big sell-offs, and then it took a little bit of time before we saw a reacceleration in terms of markets. So we saw the peak, and then at the beginning of 2018, you started to see the Fed allowing their balance sheet to roll off. So treasury bonds that they'd purchased were not being reinvested. So the asset size started to shrink a little bit. Probably not coincidentally, you're starting to see markets start to sell off a little bit. I think the issue here is that this is one of the most unknown outcomes I think anybody has studied. I mean, when we talk about giant monetary policy experiments, this is certainly the biggest. They've never tried this before. So on the way up, it worked great. But what's it going to do on the way down? Is this tightening? Is this balance sheet roll-off going to undo everything that was done over the past 8 years and cause a significant headwind to the market? So Fed policy going forward is going to be a really big topic. Price of oil, we've seen oil go from 75 down to 51. That's not conducive of an economy that's predicting growth or inflation. So those are kind of the two hallmarks of a really, really strong growth economy. And I think the Fed has tried to raise rates to get ahead of any inflation, but we haven't really seen any, or at least anything significant. So this price action in oil would imply that there's other things kind of brewing under the surface in terms of growth that may not be as healthy as some of the forecasts have shown. So China is probably the single biggest issue of all of this. You have the trade wars and tariffs that have created an unbelievable level of uncertainty. You've heard it mentioned numerous times in conference calls from CEOs that they're not sure how this is going to work. hence the growth forecast being reduced. I think one of the takeaways from this is it feels like a very binary event at this point. So if they can come to an agreement, a meaningful agreement, so to speak, I think this could be a trigger to kind of turn this market around very quickly. Now, on the flip side of that, you see that the trade deficit with China in 2017 was $375 billion. To give you some context, in 2004, it was around half of that, or about around 150 million. So it's grown substantially over the past 15 years. So when the president says that he wants to fix this relationship or normalize it, so to speak, whether you agree with his policies or how he's going about this, the numbers would dictate that he has some runway left to be firm on this. So I think when this first started, everyone thought, "Hey, we're gonna get an agreement. This is gonna be great, no problem." And now people are wondering, "Hey, is an agreement going to be reached? Are more tariffs going to be levied? Is the status quo going to stay?" It's just creating a lot of trepidation in the markets, creating uncertainty because we don't know how this is going to end up. So we are not banking on this being solved anytime soon. Not to say that it can't, but in our base case, we believe that this is going to continue to go on for the foreseeable future. Lastly, we would touch on credit spreads. So the blue line here represents the high yield bond ETF. So you can see the price has gone from around 86 at the beginning of October all the way down to 82. Again, this chart was from earlier in the week. So that number is actually probably lower right now. And then you have the yield in the orange line up to 544 for high yield bonds. So high yield bonds are very sensitive to economic conditions, to credit conditions. So this sell-off is certainly indicating that, again, there may be some trouble brewing under the surface. Normally, credit spreads for high yield run, around 500-600 basis points, but for a long time they've been in the 350-400 range. So very expensive, but now we're starting to see some concern in the credit market. In addition, you're seeing longer-term treasuries with the sell-off being bought up. You had the 10-year going from around 325 to 280, 275-ish, just recently as yesterday. So that's a significant move for the 10-year treasury bond when throughout this year bonds have underperformed significantly because rates have moved up. And to sit in front of a client and say, "Hey, we need to own duration," after what's happened was almost a losing bet, because most clients would say, "Well, why are you doing that? That makes no sense." Quite frankly, most advisors would look at that and say, "Hey, that doesn't make any sense." But we can see in significant risk-off environments, treasury bonds will be bid, and the higher the duration, the more price sensitivity you're going to see. So the ag, which was down close to 3% earlier in this year, has clawed its way all the way back to just being down around 50 basis points. So that type of move in the credit market, where treasuries are getting bid, is showing that there's certainly some concern in the bond market that this could go on for a little bit. So those are just some of the fundamental factors that we've paid attention to, and we wanted to lay those out so clients kind of understood where we're coming from the fundamental side. The technical side is also very important. What I'll say about technical analysis is that some people believe in it, some people don't, some people are in between. I think where we stand is that the biggest issue with technical analysis is most of the time frames are simply set too short. When you set a time frame too short, it's going to give you too many signals. The signals are going to be too easy to move. You're going to overtrade, and that's not our goal. We set our technical indicators on a much longer time frame so that the trends are stronger. It's more difficult to move them, and when they do move, we feel like it's significant. So, as I mentioned the bear market playbook earlier, we have different stages of risk reduction that we focus on. So this would be the first stage, and we have three indicators that we feel cluster around the beginning of these kind of big market downdrafts. And we feel like when those three things line up together and they're all in agreement, it's usually a pretty good indication that there's probably some more pain on the way. So I don't want to get into a lot of detail on what these are, but I at least want clients to be aware of them and to see them visually so they can understand kind of what we're paying attention to. So the first is it's called a MACD indicator for short, which just stands for moving average convergence to divergence. So it's kind of a mouthful, but really it's just a way to gauge momentum in the market. So the bottom pane on this chart, you can see with the red circle, you have two lines. You have a blue line and an orange line. The orange line is what's considered the signal line, and the blue line is considered the indicator. So when that blue line is above the orange line, that means that momentum is positive, and that means that the long-term trend more than likely is on its way up, and we want to be risk on, so to speak. When that blue line kicks under that orange line, that's the opposite. It means that momentum is broken down in a significant way, and that, quite frankly, risk off is a positioning that you want to take. So you can see quite clearly there, almost back in the beginning of October, this blue line kicked below the orange line, and that gap, the differential, has been increasing ever since. So that's the first indicator that we pay attention to that told us, hey, things are getting a little bit dicey now. Obviously, some people might look at that and say, why didn't you act then? Again, as a reminder, we have three indicators that we pay attention to, and we need all three of those to line up to kind of put us on the highest level of alert, because we don't want one indicator dominating all the decision making. We want to be diversified in our indicators, so to speak, and make sure that everything is agreeing, because they all look at slightly different things. The next is from Ned Davis and Associates, which is a third-party research firm that we use quite a bit. They've created something called a Big Mo tape composite. So Big Mo just stands for big momentum. This is the aggregate of over 100 indicators that they pay attention to internally every day. And it is then organized in a way that will give you a percentage reading. And you can see that those two horizontal yellow lines indicate different kind of signal levels. So anything in this chart that goes below the 58 level would indicate a sell. And then anything over the 80 would be bullish or a buy. So you can see that red line actually is kicked below that yellow line. It looks like twice now. It followed the MACD pretty closely, but was able to rebound over that sell line briefly when we had kind of the whipsawing action that we saw in November, and then it is broken back below, and you can see that that's denoted by that red circle there. So finally, the last indicator, and this is the one that had been kind of keeping us on the sidelines, so to speak, is it's also from Ned Davis. It's the volume demand supply chart. So what this does is it takes a smooth average of all the volume of all of the advancing stocks on the S&P 500 versus the smooth average volume of all of the decliners of the stocks in the S&P 500. So the thinking is that if volume is trading stronger on the stocks that are increasing, that's a bullish sign, and vice versa. So you can see here, the volume line is in black, the supply line is in red. When those cross on the supply line represents more than 50% of this chart, it's considered a bearish or a sell signal. And the first cross that we had was just recently. So that kind of gave us the indication that, okay, all three of these technical factors are lining up. We have fundamental issues that are backing this. So that went ahead, gave us the ammunition that we needed to make the decision to go ahead and kind of pull the trigger on this trade, so to speak. So as I mentioned before, those longer trends, they're stronger, they're harder to break, and they're more meaningful when they do. So when we take technical considerations, we're setting those timeframes much longer, I think, than most people would. And for some of the folks that are saying, well, why now? When you set those timeframes a little bit longer, the trends take a little bit more time to adjust, so to speak. You're not going to catch those tip tops and catch those very bottoms. And quite frankly, I don't think there's anything that can do that. But I think when the general trend moves, these do a pretty good job of notifying us that that's taking place. And then lastly, if you look at kind of what sectors of the market are trading the best, you have mostly defensive sectors. So, consumer staples, utilities. I mean, in the beginning of the year, I don't think there was an analyst out there that had a buy rating on utilities. Everyone was concerned because utilities pay high dividend rates, and they're very regulated, and they're almost bond-like. And anything that had bond-like features, we're going to act like a bond. And as rates moved up, those would get hurt. And it seemed like a no-brainer trade not to own utilities. But here we are. And utilities have been one of the strongest sectors in the market, certainly over the past few months. So you're seeing cyclical sectors that are down 20 to 35% from their highs. So the sector action is also telling us that people are changing their positioning to be a little bit more defensive, and we in turn want to kind of do the same thing. So lastly, I just want to kind of touch on what this is and what it isn't. So as I mentioned earlier, the main goal of this whole process is to be overweight or equal weight equities when the market trend's moving up and underweight when it's moving down. It's very simple to say. I think it's a little bit harder to do. But in terms of being underweight when the market goes down, you really want to avoid participating in the very worst bear market, so to speak. And again, we're not saying that we're in a bear market. We're not even saying anything close to that. But we want clients to understand that bear markets are a process. They're not an event. They don't happen overnight. So nothing that happens in the next day is going to say, yes, this is a bear market. Bear markets evolve, and they have, kind of road signs along the way that I think if they're read correctly, you can begin to move your portfolio in a more defensive position to not participate fully in those. So if you look at this chart, it breaks down, frequency of big market moves since 1945 on the right-hand side. So you've got drawdowns of 5 to 10%. They've happened 39 times. They take 3 months to recover. So almost a blip on the radar, so to speak. 10 to 20%, which we're in right now, has happened 13 times. The average recovery on those is 8 months. So again, a little deeper correction, so to speak, doesn't happen often. It take about a year to recover. So nothing substantial. Obviously, we don't want to, be fully invested when those things happen, but they too can be kind of a blip on the radar. But once we cross the 20%, that's where we're starting to get into some really destructive markets. So 20 to 30%. It's only happened 5 times. But the average time to recovery is 27 months. So that's significant. And then when you get 30 to 60, again, that's only happened 5 times, but you're talking about 62 months to recover. It's almost 5 years to get back to even. That's a long time to kind of be that buy and hold, bury your head in the sand investor and have your advisor continue to tell you, oh, just wait it out, just wait it out. Just wait it out. It's, I don't think that's necessarily prudent advice. And we want to try to take active steps to, like I said, avoid participating fully in these big market moves. So as I mentioned earlier, this is the first of 3 steps we would take to reduce risk. And, a lot of people will ask us, well, why don't you do everything at once? We have a saying that some of you may have heard around here, but the best way I think to describe it is simply every 40% market drawdown has started as a 5%. But not every 5% market drawdown turns into a 40%. So what that means is that, more likely than not, this won't turn into a bear market. So we don't want to put all of our eggs in the defensive basket now, because when the trend turns, we want to be as invested as we think is prudent. But we want to be able to capture those up moves as well, because moves after markets like this are also very good times to be invested or to invest new capital. But at the same time, all of the worst bear markets started, the same way. Seemingly, simple corrections that you should, buy the dip, but then it gets worse and worse and worse until, you wake up one day and it's 50% of your portfolio value is gone. So as I mentioned, we have a process in place. We feel like there are kind of road signs along the way that can give us, kind of a map, so to speak, of when to continue to reduce risk further. And if we went to our maximum defensive positioning, it would be essentially 20% reduction in equity based on what your neutral weighting would be, depending on what kind of model you had. So that's an effective way, we feel like, to go ahead to protect some capital if it turns into a bear market. And when the time comes, all that protected capital that we have, we'll reinvest it. And usually, you're going to get the best opportunities after the worst markets. And a lot of people say that they can do that, but few set aside the cash to go ahead and do it. And quite frankly, they can get freaked out at the bottom as well and not invest the money soon enough. So that's kind of what this is. What we want clients to kind of feel like we're trying to do here. What this isn't, I think, is also equally important. We're not making a bear market call. We're not saying this is a decision to panic. We're certainly not saying this is a decision to go all cash or to deviate significantly from your risk tolerance, unless this is really bothering you and keeping you up at night. And then maybe it is time to reevaluate that. But we want clients to understand that in these type of markets, unless you're 100% cash or bonds, you're going to lose money still. Our goal is to just make sure that you lose less on the way down so you can make more on the way up. And we feel like doing this in a tiered approach, again, is not making this an all or nothing call. Because quite frankly, if we're wrong here, if this turns around, we're not married to this. I mean, somebody said once, it's okay to be wrong. It's unforgivable to stay wrong. So if the conditions change, we have no problem taking the money that we put aside and putting it back in and getting clients re-risked. I know a lot of times that feels worse than anything, but to get whipsawed like that. But that's what prudent risk management is. It's not necessarily about trying to predict the future, but taking things as they come and then acting appropriately. So as I mentioned earlier, we'll continue to pay attention to this. There's three different things that could end up happening: reduce risk further, stay where we are, or we could re-risk accounts. But what I will say is, and I think we've mentioned it a few times, this is a process, and it's not a process that happens overnight. You think back to some of the worst bear markets that we've been through. You also think about some of the most violent whipsaws we've seen. So going back to January 2016. So that was, I believe, the most, let me think of how to say this, the largest intra-quarter reversal that the market has seen ever. So think about the most violent, massive whipsaw that you could think of. I think the market was down at its worst, something like 12 or 15%, and then it was back even within, I think, 3 or 4 weeks. So we're talking about a historic event, and it still took a few weeks to play itself out. And quite frankly, if that happens again, then yeah, we may miss the initial move on that. And I think a lot of people would. But when you're thinking of processes that can be consistent, and you're using historical data or historical events to kind of go against that, you're really trying to pick things out that are very unlikely to happen. What I will point to is the last major bear market that we had back in 2008. So you can see on this chart here from the peak in 2007 to the bottom in 2009, that process took 18 months to play itself out. There was lots of fits and starts, lots of drops, lots of false rallies. In fact, some of the biggest single-day moves in the history of the market came during this bear market on the upside. So, tomorrow, if we wake up and we have a 3% rally, we're not going to turn around and say, okay, it's time to get back invested. We've had one good day. It doesn't work like that. And we don't believe that you should try to manage money that way. So our decision to do this took some time, and the decision to do something else, to either re-risk or to de-risk, could take a little bit more time. But we wanted to show this visual so people realize these things can play themselves out over a very long time frame, and to not necessarily get impatient and think that we're going to be acting quickly every week, every day. We're going to try to take a different tact on this and know that, we understand we're not going to get everything perfect, but we think that we can do enough in the interim to make sure that clients are put in the best possible spot they can to deal with a market like this. So again, our goal is we want to be transparent with this process. We want to be communicating our thinking frequently. These markets are difficult. They're difficult for us. They're difficult for clients. So we want to be front and center. We want to give clients the opportunity to hear exactly what we're thinking while we're doing it. At the same time, if you have additional questions, you'd like to speak to your advisor, myself, anything, please do not hesitate to reach out to one of us. We're here to help. We want to be a resource. We want to guide folks through this, and we want to make sure that they're comfortable with not only where they are, but where we think we're going with all of this. So please do not hesitate to reach out to your advisor. Even if you think it's a silly question, trust me, it's not. We've heard them all. So with that said, I want to thank everybody for taking the time to listen to this. I'm sure this won't be the last communication that we have, but we certainly feel that this is a worthwhile process to go ahead and do these webinars, and we plan to do more of them in the future. So again, I thank you for joining us, and as always, if you have additional questions, please reach out. I hope everybody has a happy holiday and a great 2019. Thanks.